Okay, let's talk about bottom up investing versus top down. Sounds like a Queen song or something. My wife would get mad at me for saying online, but whatever. So it's really just two different ways of looking at stocks. And depending on how you like to approach things, big picture or nitty gritty, one might click more for you than the other. So, I mean, everyone's either top down or bottom up, whatever it is. So, top down is for macro nerds. The people want to zoom way out and see the entire economy first. You look at big picture. You start by asking, where's the world heading? Where's it going to? What sectors are popping off? What regions are growing? What industries are going well? You're looking at stuff like interest rates, inflation, government policies, big sweeping trends. Then once you decide, okay, tech is about to explode or energy is looking strong, then you go looking for the best stocks in that space. You're niching down. It's like deciding you want Italian food and then picking the best pizza spot in town. So you're starting big and then working down to the sector, the industry, all the way to the stock. This approach works for people who are obsessed with like macro trends, big government moves, supply chains, Fed policy, all that good stuff. And hey, if you don't want to spend your nights reading balance sheets, this method keeps things simple. Find the trend, ride the wave. Now, bottom up, again, Queen song. This is looking at the stock. Bottom up, this is the grind. You start with the individual companies, no matter what the economy is doing. You're combing through earnings reports, looking at leadership, product strength, competitive edge, valuation. You're basically a detective ripping apart till 2 in the morning, looking at the balance sheet and all this stuff. You're ripping the stock apart. The economy could be in the gutter, but if a company is solid, you're buying it. Maybe a small biotech firm is a game-changing drug, or some boring industrial stock is quietly raking in cash while nobody's paying attention. This style is for stock nerds. The people who get excited about PE ratios, put me to sleep, revenue growth, momentum, earnings and momentum, stuff like that. If you love doing deep dives into a company's business, bottom up investing is one for you. Now, which one's better? Honestly, neither one's better. It's like arguing whether burgers or pizza are better. That's not really the same thing. I would say pizza. They both work. You just got to know what you're into. If you're new to investing, I'd say start with bottom up. Learn how to pick good companies, understand what makes them tick, get comfortable reading financials. You'll develop an instinct for what a strong business looks like. But if you're someone who loves the big picture analysis, you read the news daily, you're obsessed with global trends and politics, then top down might be more better, that's not English, better for you. We can mix a little bit of both. Spot a booming industry with top down, then use bottom up to find the best stock within it. That's like investing on steroids, the best of both worlds. Really, at the end of the day, it's all about your style. Do you want to ride trends or do you want to dig deep into companies? There's no wrong answer. Just don't overcomplicate it. I'm big on don't overcomplicate shit. Pick a lane, start learning, and get into the game. That's my rant. Go do something smart with this info. And if you lose money, remember, it was your decision, not mine. This is not advice.